Wow, NVIDIA earnings. What a wild ride. We've got some trades to update you with. We've got covered calls that we've been selling against an NVIDIA long leaps position, and what I was calling the long Condor straddle, a big trade that we put on right before earnings. Let's see how those did. First, NVIDIA did not do well. NVIDIA basically sold off right before earnings. This is the 2-hour chart. Let's start with the long Condor straddle. We put that trade on right about here. It was in the morning on February 20th. NVIDIA was almost at its high for the week. It had ran up and there was lofty expectations around earnings. We didn't know if NVIDIA was going to go up or down, so we wanted to play both sides. So the trades that we entered into put us into a position where we could potentially profit whether it goes up or down. Here's your reminder, this was the trade. We had a long Condor call spread. These are the strike prices. We had a long Condor put spread. These were the strike prices. Overall, our long Condor straddle cost us $255. If you close all of your positions at the same time, that's your max loss. It is possible to screw that up, and we almost did that. Let's talk about it. First, max profit was if NVIDIA ended up greater than 127 or less than 150 at expiration with no trade management. It's profitable anywhere between 124.55 and 152.45. That's a nice wide range. We had a plan for managing the trade. However, what we overlooked was what happened almost right after we put it on. Back to the charts. We put on the trade here and the market promptly sold off before earnings. Earnings happened on this day right here, and wouldn't you know it, the market sold off hard again right after earnings. So the immediate sell-off that happened when we first entered the trade had me a bit concerned. Remember, our goal was to try and place the middle of the long iron condor or the short iron condor at the expected move after earnings, not before earnings. And this sell-off put the price right smack between our put iron condor. So this was the one that was in play almost right away. It immediately sold off and put us in this position in the middle of our short put credit spread. Well, if NVIDIA ends below the 123, that's the max loss. That means we don't recoup any of the money we put out on this trade. And we bought 6 of these positions. So we were out a total of $255 times 6. $1,500 we were out on this. So that was our max possible loss. And we still didn't have a clue whether NVIDIA was going to go up or down after earnings. Now, a lot of times what we see, if a hot stock drops before earnings, after earnings, it goes up. If it beats expectations. If it goes up before earnings, misses expectations, or sometimes even beats expectations, it'll come down. It'll just come down slow or hard. In this case, it came down ahead of earnings and then it beat expectations. Throughout the night, it basically held flat. That was the best case scenario for what we were hoping would happen. Now, I didn't do anything to manage the trade prior to earnings. There wasn't much that we could do. Because it moved so quickly and IV, the volatility, was so high, we couldn't get out of the trade for a profit because everything that we had bought that was on the call side was down in value, but both our long put and our short put positions were almost even because of the high volatility. So it was a challenging situation to do any type of adjustment on these trades. Well, since we kind of expected NVIDIA to beat on the earnings, I figured it might go up or hold steady, and maybe we would end up being okay. At the very least, as soon as earnings are done, volatility drops drastically. That's when we have the best opportunity to profit, even if the stock is not where we want it to be price-wise. So at market open, the stock had gone up. You can see the open price up there. It was at 135. 135. That puts us at the bottom of our long put spread. That's where we want to be. We want to be in that area. If we're in that area, this put spread is most profitable. These two are not worth very much, and this one could potentially expire worthless. But with that IV crush, we could get out of both of these positions for a good profit right away. Did we do that? Not quite. This is what it ends up looking like. I highlighted all of the trades. You can see the amount that we paid for it, the commissions that we paid, the fees that we had to pay for doing the spreads, and then we have our total on the side. Ultimately, there were 44 positions that we got into and out of for this trade. It was a little bit complicated. Here's where we got into it, and then here's where we started to sell it off. So earnings happened. We don't know what NVIDIA is going to do. It starts to drop, so we immediately sold the long call options to capture that value before it dropped even further. Then we bought back the short call options. Price was bouncing around and it started to go up. It looked like there was some pressure to go up. We ended up clearing out of the long put positions, but we didn't clear out of the short put positions because I got a little greedy. I thought that there was a good chance NVIDIA was going to keep going up, and those ones might end up expiring worthless. And we could have gotten a really good profit in that scenario. Because when I cleared out of the long puts right here, we recognized quite a bit of profit on that trade right there. If the other ones expired worthless, we would have profited quite a bit more than originally anticipated. As it turns out, NVIDIA kind of bounced around and went back down before I was able to close out that other position. NVIDIA came down really close and was hanging around at the sold puts, which put those as very expensive, and my puts that were farther out that we had sold a lot less expensive. So our profitability, had I closed at the exact same time, each of these contracts, I think I would have bought back for about $1.12. That would have been really good. Might have been $1.30 or $130 for each spread. As it turns out, it bounced around. The contracts to buy those back ended up getting up close to $250. Ultimately, we got the opportunity to close out of them around $160, but it really limited our profits. So we got lucky in general that NVIDIA didn't drop after earnings immediately and go all the way through our lower strike price, giving us our max loss of $1,500. But we managed to profit on this despite the massive drop that NVIDIA ended up taking that day. We ended up with $161 profit after fees, $100. So we risked $1,500 and we won $100. That was over the course of 1 week. Now, it might seem hardly worth it. That's over a 6% return in 1 week. If you could do that every week, you just made a 300% profit on the year. So it's not too bad. We did happen to get lucky there. If you look at the low point right there, on the day after earnings, it dropped all the way down to 120, which was well below our max loss point. And the day of expiration, it dropped all the way down to 116. Yikes! It just kept getting hammered. So we managed to get lucky. We eked out the win. Sometimes it's better to be lucky than good. What would I do different if I were to do this again? I think we put the trade on too early. I had the thought, I was recording videos. I thought, I'm going to put this trade on and I'm going to record it. And I'm going to share it with you guys. And it turns out I did it way too early because there was a big move. Next time I would wait until right before close of day on earnings. That way we get the maximum volatility and there's no chance for the stock to move until after we hear about earnings. That's the ideal scenario. We expected NVIDIA to move after earnings. Had we put it on at the end of the day, our midpoint would have been 131 and our max profit on the put side would have been between 126 and 120. And as it turns out, the very next day, it closed right where we needed it to be at the 126. We could have waited. The very next day, the low point of the day was still within our max profit window. We would have done excellent to have closed it at some point during that day when it was in the middle. On the day of expiration, it went down to the bottom of where our max loss would have been, but it didn't end there. Had we gone to expiration, it would have finished right exactly where our target was for max profit. So that's the change I would have made if we had put it on right before the close, right before earnings. That would have been the best option. Moving on to our other NVIDIA trade that we've been ongoing with. This is our poor man's covered call. We purchased originally on January 27th for $5,400. We bought and sold as it ran up prior to earnings. We ended up positioning ourselves for earnings by moving all the way out, locking in potential gains of $600. and leaving another potential 400 for 2 years expiration. Well, because of that big drop, we changed what we were going to do before earnings because I thought there was a good chance NVIDIA would go up after earnings, and we wanted to be able to profit from that. So there were some gains to buy that back, and then we were able to sell another call at the 140 strike price. We have the 85 strike price. We sold the 140 a little bit before earnings for $400. Now, our expectation was we didn't know if it was going to go up or down. So we wanted to do this at an opportune time where it put us back into a position that we would be able to continue selling covered calls, make that income, which was our original goal for this trade. We wanted to use this money to make income each week and ultimately make quite a bit of profits over the next 2 years. Well, because of how quickly NVIDIA moved, we were basically limited to $1,000 in profit or $1,200 in profit over the course of just a couple of weeks until we got this opportunity. Now, it turns out it wasn't as beneficial a move as we hoped it would be. If I had held on to this position, it would have dropped quite a bit more over the next few days. That would have been the time to get out of it because this was losing value at about the same rate that this was losing value. But when I shifted it back to this position, this one did not lose value as quick as this one did. This was worth over $6,600 when we moved this one back. When this dropped in value and NVIDIA came way down, this ended up coming back close to $5,900. So we were like $500 up at that point. And then after earnings, this 400 worth almost nothing. We bought it back for pennies on the dollar, but our long call, NVIDIA dropped down below where we first bought it at. And so this was actually negative for a brief moment. We lost every bit of profit that we had locked in on that one when we had this position. Not the end of the world. We got 2 years till expiration for this. So it's not the end of the world. We ended up purchasing that one back, locked in some profit. This, unrealized profits or losses. Potentially for the next 2 years, unrealized profits or losses. This is realized. We got that money, sold that call for 400, had the space to potentially make a whole bunch if NVIDIA went up. We didn't get it, but that's okay. We made $392 on that trade. That's a 376% annualized profit. If we could do that every week, we're not able to. That's not realistic, but it's just nice to know that sometimes you can make some really good money on these things. Now, we sold another one that same day. I had to drop it down to the 133 strike price, and I knew I only had 1 day till expiration. I wanted to leave some room for NVIDIA to shoot back up. Remember, it was down around 125. It didn't do much. We ended up buying this one back the very next day for $2 and a decent annualized return for a 1-day trade. And then later that day, we sold another one at the 130 for $130. You can see NVIDIA closed at the 124 on that day. So we left ourselves with $6 of room for it to go up over the next week. During that day, NVIDIA dropped all the way down to 115. When it made that drop, this 130 that we had sold dropped down to about an $86 value. I contemplated closing it and rolling it to a closer strike price. It felt like NVIDIA was gonna go up again. So instead, what we did, we had a potential $44 in profit if I had closed that right there. Rather than close it, I used some of those potential profits to open a debit spread at the 131, 132 strike price. It only cost us $13. So of the $44 that this was profitable, I spent $13 here. The reason I did that was because I still wanted space for NVIDIA to go up. I still think that NVIDIA can go up, and when it does go up, it goes fast. If it runs up through that strike price and it goes to a point where I can't catch up to it very easily, this gets me $100 at expiration if it's above 132. I can use that $100 gain, or really $87 in profit, in order to help roll this to a higher strike price and collect some income the next week, or we just collect this as income. If we end up right near 132, I make money on this trade and I roll this out and up, or straight sideways. Just depends on what's going to happen. But the difference between this position and the position I'm in now on the downside is only $13. We'll still make some good money. That's one of the ways if we encounter a drop that we think is probably temporary, we don't want to close out our covered call. We still want to be able to make that money, but have the potential to pull in some more profits if it runs through our strike price. This is how we do that. Where are we at the end of this week? This is how much we're out at the moment. Our original, what we spent, $54.20, not accounting for what this is worth right now. We're at about $500 in realized gains after all of those trades. And we still have 2 years that we can continue to sell covered calls. The value of this call, as of right now, is about $5,700. So we're back to $300 profitable on this. And we got $500 profit down here that we've locked up. Not too shabby. We're almost in the same position that we were at prior to earnings. Remember, prior to earnings, we had about $400 or $500 in profits, realized gains, and a potential $600 if we waited 2 more years. Well, right now I could just close that, get the extra $300, and we've already got about $500 here. So we're about $800 that I could get if I just closed it today. Had we closed this one the last time, we would have been at about $1,200. So we were in a little bit better position there, but I didn't have any capacity to continue selling covered calls on this. So while it may not have been the optimal play, we're still doing okay. We still have a really good chance to make a lot of good profits on this for days and weeks and months to come. If you like the content that I'm putting out here and you appreciate the effort that we're putting into this to help educate you, hit that like button and subscribe. You can follow along on this trade and other trades as I continue to share what we're trying to do. There's all kinds of different strategies out there using options. So if you want to get better at options, be sure to ding that notification bell as well. We'll see you next time. The next 20 seconds determine your future. Subscribe, meet with me, or continue educating yourself with these videos right over here. I appreciate you. Now go maximize your cash flow.